Good afternoon and welcome to the third lecture in this series. Today we'll be looking at market profiles. Our objectives: number one, to understand the types of market profiles that exist in the marketplace, and secondly, to be able to identify each individual market profile by yourselves, not with my assistance. So hopefully we'll get to a point where you will be able to identify each of these market profiles by yourselves. So let's proceed. What is a market profile? Now, number one, a market profile in forex trading is a way we use to identify the current market condition of the asset we are trading in. So, when we arrive at our charts, we need to be able to identify the current market condition of that particular asset that we want to trade. So, for us to be able to do this, we need to know the market profile of that market. An asset refers to a pair which you are trading. So when we talk of the word asset just means the pair you are trading. It can be USD JPY, EUR USD, GBP USD, so on and so forth, even DXY. I believe some of us are familiar with DXY because I introduced it, I think, in the trading view video. Then we need to know the current market profile of an asset to be able to trade it effectively. So we need to know what the current market condition is on that asset for us to be able to trade it effectively. Without knowing this, it will be difficult for us to trade that particular asset. The market, as we know it, consists of three market profiles. So generally, we know the market to have three market profiles. If there's any other profiles outside of these three, then it's not for you to know. These three are what we call the main market profiles. So anything else is just noise. So we just focus on these three. With these three alone, you can be able to understand how the market moves. Number one, the bullish markets. A bullish market is a market where the buyers are in control, meaning that the market is in a uptrend or a bullish trend, heading in an upward direction. As you may already know, I like to describe the market when I'm describing it as a market that moves what in a direction. It's either going up or it's going down. So when we talk about the bullish market, we mean that the market is heading upwards. It keeps rising higher. That means the price is what? The price is rising constantly. So in a bullish market environment, we see the market create what? A low, then a high, then a higher low, then a higher high. Then this pattern continues, a higher low and then a higher high, a higher low and then a higher high. So in a bullish market, what do? We focus only on buys. So any other thing outside buying does not concern you in a bullish market. You don't want to sell it. You don't want to do anything otherwise. You just want to focus on the buy trend. So that is why we call it a bullish market. So in a bullish market, the only thing you do is to buy. You look for buy opportunities. So you can see the examples of the bullish trend below in the pictures and on the side as well in the picture. We go from a low to a high, then we create what? A higher low, then a higher high, a higher low, and then a higher high, so on and so forth. As we proceed down in the video, you will be able to understand better what I mean by higher lows and higher highs, because I will explain better both off the chart and on the chart. Secondly, a bearish market. A bearish market is a market where the sellers are in control, meaning that the market is in a downtrend or a bearish trend, heading in a downward direction. Therefore, this is the opposite of a bullish market. In a bearish market, we focus on sales only. So the bearish market is the opposite of a bullish market. Why? Because in a bullish market, we see the market going what? Higher and higher and higher. Whereas in a bearish market, we see the market heading in a downward direction, meaning that it's going lower and lower and lower. And in a bearish market, we see the market keep creating what? Lower highs and lower lows, as we can see in the examples below. We see the market creating lower highs and lower lows, lower highs and lower lows. This is what makes the bearish market. So in a bearish market, we focus only on what? Sells. We do not want to buy in a bearish market. If you try to buy in a bearish market, you will end up losing. So the best thing for you to focus on is to focus on the sell side of the market. Thirdly, a consolidation market. A consolidation market is a market where neither the buyers nor sellers are in control, meaning that the market is neither in a uptrend or a downtrend. In this market profile, the market is not bullish or bearish. Rather, we are in a tug of war between the buyers and the sellers until one wins. So in a consolidation market environment, the market is not going higher and it is not going lower. The market is not going in just one direction, but rather we see it buy, then sell, sell, then buy. So in a way, it is just bouncing up, down, up, down, up, down. So the direction is not clear. That is the key word there. Clear. The direction is not clear. So until the direction becomes clear in a consolidation market, we need to be patient, because there's not one clear direction that we can just say, oh, it's buying, let's follow the buys, or oh, it's selling, let's follow the sells. Because the direction is not clear, rather, we have patience and wait until one side of the market wins. So either the buyers will win or the sellers will win. So down below, we have an example of a consolidation trend, and you can see exactly what I mean. You see the black line horizontal and the one below it horizontal as well, and then observe what price is doing within the range of those two black lines. It is just bouncing up, down, up, down, up, down. That there is an example of a consolidation market profile. Now, the important question: which market profile should we trade? When we arrive at our charts, we first of all analyze the market profile. So when you come to your charts, as you open your chart, maybe on TradingView, the first thing you want to know is what market profile or what market condition are we currently trading inside of. If the market is bullish, what do? We look for buy opportunities. Likewise, if the market is bearish, we look for what? Sell opportunities. So when the market is bullish, meaning that when the market is buying upwards, all you are focused on is what? Looking for what? Buy opportunities. And when the market is selling downwards, all you are looking for is all you are looking for are sell opportunities. Whereas if we spot a consolidation profile, we do not look for trades. Rather, we wait for price to leave the consolidation and pick a side before engaging. So whenever we come to the marketplace and we see the opposite of what? A bullish or bearish market, which is a consolidation market, meaning that the market is not buying, is not selling, it's just bouncing up, down, up, down, up, down in a tight range. So in that scenario, that is the only time that you shouldn't trade. You can trade a bullish market, you can trade a bearish market, but a consolidation market, you should avoid it until you get a clear direction. The market needs to pick a side before you can engage. Now let's have a look at some examples of these market profiles on the charts. But before we go to the charts, I would like to explain briefly a bit more what these three market profiles actually look like. Thank you. So before we proceed to the charts, just to cover again what I've explained in the PowerPoint presentation. Let's begin with the bullish trend. So the bullish trend is a buy trend. So when we have a buy trend, what we are seeing in simple terms is we are seeing price what? Create a swing low, move to a swing high, retrace, create another swing low, takes the previous swing high over here, and then what we'll do again, we'll come back down again. We just keep on repeating this same phenomenon again. Sorry. come back down again, and then we go again. So all we are seeing essentially is what price is what creating swing lows down here, then a swing high, let's say up here, then we come back down into the previous swing low down here, then we go and take the previous swing high, then we come back down again, create what a new swing low inside of a previous swing low, and then we go up to take a previous swing high. So price keeps creating new highs. That is why we call it a bullish trend. We keep buying higher and higher and higher, going from swing lows to swing highs, swing low to swing highs. Then the opposite of this, let me get rid of all this. Sorry. So the opposite of this will be what a bearish trend, which is just basically the opposite of what I've just explained. What do we see in a bearish trend? In a bearish trend, we see price what create a swing high, let's say up here, then we go down to create what a swing low, then we retrace back into the previous swing high, then we come to take the previous swing low. So now I've created what a new swing high up here. So what happens again, we retrace back into what that previous swing high before attacking the previous swing low. So we keep repeating this: retrace, attack, retrace, attack. So that is a bearish trend. And then in a consolidation trend, what do we see? Let me get rid of this. In a consolidation trend, we see a marketplace where the buyers and the sellers are struggling. They are fighting against each other. So the market is not going up like this in a bullish trend, and it's not coming down like this in a bearish trend. So what do we see in a consolidation market? This is what we see. Let me show you now. In a consolidation market, we actually see a scenario where price is struggling to break out. So let me just use this to describe it. We see price goes from a swing low. So let me draw that again. 1 and 2. So what do we see? We see price go from a swing low to a swing high, then back to a swing low to a swing high, swing low, swing high, swing low, swing high. So can you see what is happening here? We are neither taking old swing highs, nor are we taking old swing lows, but rather we are dancing in between. We are just dancing in between, trying to find a position to take. So neither the buyers or sellers are in control, but rather that's why it's the word tug of war. They are fighting, and you know how a tug of war is. Until one side wins, there is no winner. So until there is a breakout, what we call a breakout, maybe price, for example, let me show you what I mean by breakout. So let's say, for example, after the tug of war, price goes up, down, up, down, up, down. Then all of a sudden, price what? Phew. Now we've broken a previous swing high. Can you see that? So what now happens? We can now start trending again. Swing low, swing high, swing low. So let me get rid of this and then show you a bearish scenario. So in a bearish scenario of a consolidation trend, let's say we're in a consolidation like this, up, down, up, down, up. Then all of a sudden we break out. We have taken what the previous swing low. So what do we see? Next, price goes back into a previous swing low, and then price goes back into a previous swing high, and then what attacks a previous swing low, back into a previous swing high, and then we attack a previous swing low, so on and so forth. So those are the three market trends that you need to focus on: the bullish trend number 1, the bearish trend number 2, and then the consolidation trend number 3. But like I explained in the PowerPoint, we only look to trade two of these, the bullish and the bearish, because those are the clearest trend. the consolidation can be traded, just as you can see in this picture example, only when you have broken out of the consolidation. But as long as we are still inside the consolidation, up, down, up, down, up, down, and we keep going like this, then we do not want to trade that market. We have to either see price break above or break below. So now taking us further, using the charts to give us a good example of a bullish trend, a bearish trend, and then a consolidation trend. I promise this video will not be too long, because with the presentation and then the example on the drawing board and now on the chart, I think that could go over 10 minutes. So I'm going to try and keep this as brief as possible. So on the screen right now, if you are very sharp and you have been paying attention, then you already know what is happening here. Over here we have an example of a bullish trend. So why is this a bullish trend? Remember, with your bullish trend, we are going from swing lows to swing highs, then higher swing low to what, a higher swing high, then a higher swing low to a higher swing high. So where can we see that? Let's start from down here. So first and foremost, we have a swing low down here, then we move towards a swing high up here. Let me make this line red and then thicker. So can you see that? So from there towards a new swing low down here, and then from here what happens next? We move from a swing low to a swing high. Now remember what I told you, whenever we are creating new swing lows and swing highs, what are we doing? In simple terms, we are going from a swing low, then what are we doing? We are attacking what, a swing high, which is up here. For example, we are attacking a swing high over here. Sorry, my magnet tool is on. So we're attacking a swing high over here. So can you see that? So sorry, this is the swing high I was referring to. We're attacking the swing high. Then we repeat the same thing again. As you can see, we then go what, from that swing high up there, we go down to create a new swing low, and then from here again we go what, to create a new swing high above the previous swing high. Now if you observe what is happening here, in a bullish trend, what are they doing? They're respecting swing lows, and what are they doing? They are breaking above swing highs. The same thing here again, respecting a swing low down here, attacking a swing high up here. Sorry, my lines are not too accurate, so let me just turn on this magnet tool. Sorry, let me take it off so I can draw this easier. Disable. So let's draw that again. Attacking the swing high up here, respecting the previous swing low down here. Then we attack what, the previous swing high, respecting the previous swing low. So that means what is coming next up here, we are potentially going to attack the previous swing high. So I'm coming, let me use this other tool over here. Let me get the arrow back. So as you can see, from here we move again to create a swing low. Then from that swing low we move to create a higher swing high. From there we move to create a swing low. then we move to create what? A higher swing high. Then once again we move to create a swing low, a higher low, and then we move. Probably this is what is coming next to attack the previous swing high. We have not yet attacked it, but I believe that should be what would happen next. So you can see the trend. We are respecting what? Swing lows by creating higher swing lows above previous swing lows, higher swing low above a previous swing low, and then we have it again, higher swing low over here above a previous swing low, so on and so forth. But what are we doing? We're attacking old swing highs. So in a bullish trend, you are looking to what? Buy swing lows, targeting what? Swing highs. You are looking to buy what? Swing lows, targeting swing highs. That is the structure of a bullish market. And you can see how the market keeps moving higher and higher and higher and higher, going up, up, up and away. So let's come and see what a bearish trend. What does a bearish trend look like? Over here we can see a bearish trend forming. So in a bearish trend, we are doing the opposite of a bullish trend. So in a bearish trend, what do we see? We see price go from what? Swing highs. Let me get the arrow tool back. We see price go from swing highs to what? Swing lows. Then from that swing low, what does price do? Price creates a new swing high. Then price what? Attacks a previous swing low. Then goes what? Create a new swing high. And then what does price do next? Attack a previous swing low. So we keep repeating this phenomenon back and forth. Swing high, then we attack what? A swing low. So this is the opposite of a bullish market. So in a bearish market, we are seeing what? Highs being respected, and we are seeing lows being broken. Highs being respected, and what are happening to lows? Lows are being broken. So we keep doing this over and over again. So in a bearish market, essentially what is happening is that price is what? Creating a swing high, then a swing low, then price is retracing back into a previous swing high, failing to take it, but then attacking a previous swing low. And we continue to do this. We go back from here now, we create a swing high, then we come down creating a swing low. But when price returns back, we create a lower swing high, failing to attack the previous swing high. Then we attack the swing low. So in a bearish market, we are respecting highs and breaking lows, which is the opposite of the bullish market, as you can see down here. In a bullish market, what are we doing? We're respecting lows and breaking highs. Respecting lows, breaking highs. Respecting lows, when what are we doing? Breaking highs. We keep doing that in a bullish market. We respect the lows. Then what do we do next? We attack the highs up here. Once again, respect the low, then we attack the high. So that is why I said over here, what could we possibly see in the next couple of days or maybe weeks? We can see price go to take this high. So we have created a new low. So potentially price will attack what? The previous swing high. Then in the bearish market, as we're seeing, this is the opposite of a bullish market. From swing high up here, price creates a swing low, then creates a lower swing high respecting the previous swing high. And then what do? We attack the previous swing low. So we keep doing this just like with the bullish market, but the opposite here. Swing low, we create a new swing high, failing to break the previous swing high, then we attack the swing low. Then we create a new low again, then we create a high. This high is always lower than the previous swing high, and then we attack the old swing low. So to summarize the bullish market and the bearish market, in the bullish market, we are what? Creating higher lows and we are breaking old swing highs. We are creating new higher swing lows, not breaking the previous swing lows, but what are we doing? We are breaking previous swing highs, just like we can see. Then in a bearish market, we are doing the opposite. We are creating lower swing highs and we are attacking previous swing lows. We create what? Lower swing highs and we attack previous swing lows. Now let's look at an example of a consolidation market. We have one right here. So as you can see, what does the market do over here? Let me get the arrow. The market goes from swing low to swing high. Then we keep consolidating because we keep going swing low, but we're not actually breaking out of any of them. We are just creating swing low, swing high, swing low, swing high. You can see how this is different from our bullish and bearish market. So we are creating lows inside of lows and highs inside of highs. We are not breaking out of them. So starting from here, let me zoom in a bit. We go from this low to this high, then we come back to this low. So what would you expect next for price to attack this high? Now price goes but barely breaks this high. Then we come back down and we barely break this low. Then we try to go back to take that high, we didn't take it. We try to take this low, we struggle to take it. We try to take this high, struggle to take it. Try to take this low here, we struggle to take it. So this is a consolidation market. And what did I say about a consolidation market? In a consolidation market, we mark out the high and the low of the consolidation. So let's say this was the high of the consolidation up here. And then this is the low of the consolidation down here. So now what are we looking to see happen next? We are looking to see price either break above the high or break below the low of the consolidation. So as you can see over here, price goes above the high finally after a while, and then they attack the low of the consolidation, and then from there we break out and we start selling. So from after they have this nice move downwards over here out of the consolidation, this move, you can see how they start selling again all the way down here before the buy trend continues again. So this over here is a consolidation market. This is a consolidation market around here, this area here. Then from the consolidation market we break out and we start what? A bearish market profile. High to low to high to low to high to low, breaking lows, respecting highs. Then we keep going downwards until we come into this bullish market trend over here. From here we started going from low to high, low to high, breaking previous highs, respecting previous lows. So I believe this is enough for the explanation of what a bullish market is, a bearish market, and also a consolidation market.